In 1997, the Nobel Prize in Economic Sciences went to Robert Merton and Myron Scholes for the Black-Scholes model. The formula has been called the trillion-dollar equation. It told traders they could make risk disappear. But in the end, it nearly brought down the system. To understand why, we need to go back. Before their work, figuring out what an option was worth was a mix of guesswork and gut feeling. There was no standard formula, no agreed method. But in the early 1970s, Merton, Scholes, and the late Fisher Black came up with something revolutionary, a way to calculate the fair price of an option based on a handful of observable variables. This became known as the Black-Scholes model. And while it might sound technical, its impact was transformative. For the first time, financial markets had a reliable, scientific method for pricing complex instruments. That changed everything. Traders could hedge their positions more precisely. Banks could manage risk more effectively. The model helped turn derivatives from an obscure niche into a global market worth trillions. Financial engineering, previously more of an art than a science, took off. Universities built entire courses around it. Investment banks hired armies of quants to apply it. Options trading soared across equities, commodities, and foreign exchange. But the real revolution came with products like bonds and debt, which contained embedded optionality. Now, risk itself could be sliced up, priced, and sold to enthusiastic buyers. On screen, you can see the Black-Scholes formula for a European call option. It looks quite formidable. There's an E raised to a power, Greek letters, and natural logarithms. But basically, it's doing something surprisingly intuitive. It's measuring the probability, assuming a slightly adjusted normal distribution, that a stock will finish above the strike price at expiration, minus the probability that it won't. In other words, how likely is it that the option will pay out? This basic structure wasn't exactly new. It's similar to the confidence interval testing you might have done at school. A stock valued at $160 today might rise to $240 at maturity. The payoff is the area under the curve, described by the first part of the equation, minus the strike price, described by the second part of the equation. Traders and mathematicians had been using rough versions of this idea since Louis Bachelier in the 19th century, but the real problem was how to discount that payoff. Options are risky. Sometimes they expire worthless. At other times they can generate big payouts. So what discount rate should you use? 10, 50, or 80%. Get it wrong, and you could end up paying $4 for an option that is only really worth $2, and that could wipe you out. But this is where the genius of the Black-Scholes model came in. It got rid of the guesswork. Instead of trying to guess the risk premium, the model used a clever technique called delta hedging. By holding an option and simultaneously trading the underlying stock in the right proportion, a trader could offset the ups and downs. If you were long a stock and short the option, or vice versa, then for small changes in price, the risk was neutralized. Conveniently, the hedge ratio, how much of the stock you'd need to hold to stay hedged, comes straight out of the Black-Scholes formula. It's the option's sensitivity to price changes, and it's simply ND1. This delta hedge changed the situation. It created a risk-free portfolio, and because it was risk-free, it could be discounted at the risk-free interest rate, which is a known, observable number. You could use the yield on a US Treasury bond, which you can get from a Bloomberg terminal, or even a newspaper. So now, instead of estimating wild discount rates, you just input stock price, strike price, time to expiration, volatility, and the risk-free rate. And out came the option's fair value. This made options pricing precise, and it made it extremely appealing to traders, banks, and executives alike. Now you could claim, with some credibility, that you were making money risk-free. And if that's true, why not scale it up? The profits were small on each trade, so firms began using leverage, borrowing to amplify their bets. But here's the problem. The model was brilliant, but the assumptions behind it were idealistic. It assumed continuous trading, perfect liquidity, no transaction costs, that you could always rebalance your hedge instantly and cheaply. In the real world, things are messier. Markets jump, liquidity dries up, volatility spikes, and when things go wrong, they go wrong fast. Suddenly, you can't hedge, you can't rebalance, and your supposedly risk-free position starts losing money fast. Returns aren't always normally distributed either. They can have fat tails, which are extreme events that happen more often than the model expects. And when everyone's using the same strategies, the risks become systemic. That's exactly what happened with long-term capital management in 1998, a hedge fund run by Merton and Scholes. Their models worked on paper. But when liquidity dried up during the Asian financial crisis, all of their bets turned sour and nearly brought the financial system down. It should have been a warning. But the market kept growing. So did the leverage. Until the 2008 financial crisis. So where does that leave us today? The Black-Scholes model is still a masterpiece in finance. An elegant insight into how risk can be carved up, measured, and priced. But the assumptions behind it don't always hold, so the results aren't always reliable, which means it isn't truly risk-free. After the 2008 crisis, regulators cracked down. Leverage was cut. Proprietary trading, where banks, even high street banks, gamble with their own capital, was outlawed or heavily restricted, especially at institutions backed by taxpayer guarantees. But hedge funds and sophisticated investors still use it, and rightly so. Black-Scholes still offers a great insight into risk. So hedge funds still arbitrage the Greeks. They still delta hedge. They still run the models. But they do so with more caution. Because in the end, while the formula is beautifully elegant, the real world is beautifully complex. A link to the next video and Nobel Economics Prize playlist should be showing now. Just click to keep watching. I hope you enjoyed this video. If you did, then please like, subscribe, and comment. Thanks for watching.